Welcome back, everyone. Now we have Mike Lawrenson joining us from Laurium Capital. Mike, thanks for joining us.
Thank you, Anil. Thank you for the opportunity.
Laurium manage our Nedgroup Investments SA Equity Fund and is quite a unique portfolio, I believe. I mean, how would you describe the philosophy and approach that you take in managing the fund and what, let's say, makes you special as a house?
Thank you for that question. So we're a boutique focused business. We're owner managed. We have skin in the game. We a fundamental house focusing on bottom up research, and that's how we build our portfolios. And this particular fund is obviously SA only focused, domestic SA. And yeah, we think we've got the right people. You know, we've got the skin in the game, as I mentioned earlier, and I think we've got built up a pretty decent record over time.
Yeah, we definitely think you guys have what it takes. So thank you. So Mike, I guess if we had to jump into, let's say, some of the performance and attribution for the fund now, we'll talk through that. But specifically, if you look at the last 12 months, I mean, the market has been quite concentrated. How has this influenced your portfolio construction over the period?
Well, I guess in a way it's made it a little bit more difficult because, I mean, the obvious one is gold. If you hadn't owned gold, it would have been problematic. We were fortunate in that we did own gold, and where it counted, we actually owned the right gold counters. And in this case, we had a particularly large overweight position in Anglo Gold, which has played out really well, and in fact played out really well in this first calendar quarter, despite gold having the wobbly that it did from the start of the Iran war.
And then Mike, I see, like, if you look at your performance numbers, it's amazing how high your consistency rates have been. Like, what would you say has led to this such high consistency over rolling periods?
I think it's largely around sort of conviction in our strong ideas, and the fact that, you know, we do focus primarily, as I mentioned earlier, on bottom-up research rather than on sort of macro themes. I mean, obviously the macro is important, and you know, I guess March is an example where, you know, where macro themes come to the fore, and you know, you can be hurt. But it's more the consistency in our bottom-up stock selection, and then, you know, where we develop strong ideas, you know, we bet on them quite strongly.
Mm-hmm. In particular, if you consider how, you know, let's say, concentrated and volatile South Africa can be. I mean, you really have to stick to your process and be disciplined from that perspective.
Absolutely, and I mean, PGMs is probably an example as well. I'd been quite bullish on PGMs, just on the sort of medium-term outlook, and I'd been wrong for a while. But you know, despite PGM prices falling, you know, my conviction levels didn't fall. In fact, my conviction levels went higher, and you know, as a result, we got some fairly decent returns last year, and obviously things were looking really strong until the end of February, and you know, they've come off quite badly in the month of March. Had a bit of a bounce in late March, early April, and I'm still fairly constructive on the outlook for PGMs.
And then, Mike, I guess, I mean, you started mentioning about performance over the quarter. Let's kind of do a bit of a deep dive into attribution over the last 3 months or so. What were some of the big contributors and detractors?
Anglo Gold was a strong contributors over the quarter and over the year. Sticking to the annual performance for now, for the 1 year performance. Impala Platinum was another strong performer. Absa Bank was another strong performer. On the negative side, we were obviously hurt. Naspers process, they performed poorly in the quarter. And then on the retailer side, we own Foschini, and that has been a disappointment. It's one we are reassessing our views on that stock. And then more recently, Mr. Prices has also disappointed post the acquisition of NKD. We do remain positive on that one. We think that the negative story around the NKD acquisition itself is more than priced into the market. They had a recent update on that, and while there were no new financial numbers, at least we got confirmation that the planned rollout of stores within NKD can be self-funded, and hence there won't be further cash calls at a Mr. Price level. So on a sort of a 10 times multiple, we remained fairly optimistic on that one. And Sasol, obviously, in the quarter, it's a stock that we exited last year. We were negative on the outlook for oil as such. Most commentary and market expectations for calendar year 26 was for a bigger surplus of oil. Clearly, an Iranian war, and especially, if the straits are blocked, that changes the outlook very quickly. And obviously that also counted against us in the quarter.
I mean, I'd just like to kind of pause and let's look at your sector exposures now, right? I mean, where do you think you've been, let's say, deliberately cautious versus taking a bit more risk in the portfolio?
So I guess we added, as I mentioned, Mr. Price. We were, or we are, cautiously optimistic on the outlook for domestic SA. We were expecting inflation to bottom. We were expecting interest rates to fall further into this year. We were also constructive on some of the sort of self-help that we were getting, whether it was from Transnet, obviously Eskom's out of the way. Clearly, we were actually starting to see some green shoots. Unfortunately, the Iranian war now, raises some question marks around that. But that is one where we added extra exposure. FirstRand's another one. It's our largest banking stock. Obviously, there have been concerns about that vehicle commission issue. We've received an update from the UK authorities. Obviously, their provision, they've increased the provision that they had previously provided for. But I guess the good news there is for the first time, they've actively said that they're looking to potentially sell that Aldermore business. If they're successful with that, it'll significantly improve the ROE. So that's another one where we've added to our positions. We've been adding to Process. If we look at what's happened to Tencent, which is the primary asset within the Process and Naspers portfolios, it got sold down in the first quarter, in line with AI stocks generally, both globally and in China, but more so themselves on concerns that they were lagging from an AI perspective. But their recent results have shown that not to be the case. I guess what was more a concern more recently was that they announced that they were increasing both OPEX, they were doubling OPEX and they were increasing CAPEX. That was further rollout of AI. And a lot of, certainly US stocks, when you talk about the amount of CAPEX you're spending, you get these massive rallies. In this case, we didn't see that because Tencent spoke to some of that cost, some of the DNA from that increased CAPEX coming through on the operating margin and impacting it by only 2%. And then also they're having to hire more talent. So those are some of the areas where we've added risk in our portfolio, or added conviction levels.
Okay, brilliant, thanks. And I guess if you just look at, let's call it from an asset allocation perspective, I mean, one chart that you've shown us many times previously is just kind of the comparison between South African PE versus bond yields.
Yes.
And there was previously quite a big gap. I mean, that gap has narrowed very quickly.
Yes.
Any comments on that, please?
If you looked at the inverse of the bond yields versus the forward PE of domestic SA, a big gap had arisen at the back end of last calendar year, and either it was either bond yields were wrong, or the outlook for domestic SA was poor. We were fairly positive on both, although bond yields had sort of reached 8%. We thought that that wasn't significantly out of line, just given growth expectations, given where the strength of the currency and the outlook for the current account. So we were, yes, they were sort of toppish, but we didn't expect them to fall significantly from there. But it was more, the market wasn't believing the outlook for the equity markets. Roll on 2 months and suddenly you have an oil crisis and things change dramatically. In this case, the bond yield fell off a lot more than the PE, so there was a narrowing of that. Looking forward from this point, we, as I said earlier, we remain optimistic for the outlook for the SA economy and for DOM SA stocks. Clearly, if we have a protracted war and a protracted environment of high oil prices, that's going to be more difficult. But if we can see a situation where the war ends in the next sort of 4 to 6 weeks, I think some of that optimism and some of that growth can come back, and you could probably see bond yields heading back down to 8%. So generally speaking, we optimistic on both, but obviously subject to some sort of successful outcome.
Yeah, I mean, South Africa is still looking quite cheap compared to global.
Absolutely, and I didn't. Obviously, I haven't touched on SA versus everybody else. I mean, on one of the other slides, you can see that everybody's corrected, and South Africa as well, despite our forward PE being the lowest of all those indices that we show.
And Mike, I guess just before we finish off then, any quick comments on your outlook for SA equities, please?
Like I alluded to earlier, we remain optimistic for SA Inc. We believe that we're going to see some of those green shoots continue to come to grow bigger. Clearly, the outlook for oil is the biggest sort of curveball at the moment. But we're happy with our portfolio construction. Obviously, there are those stocks that are more dependent on the SA outlook, and that was where we had sort of increased our exposure. But yeah, generally speaking, we optimistic on the outlook, and we think the portfolio is well positioned to take advantage of that.
And Mike, I guess, I mean, you have spoken a lot about positioning already. I guess any final comments on that?
Well, I guess where we have looked to hedge some of that risk, I mean, obviously Sasol would have been a good opportunity. Clearly that's run away. It's doubled in the year. We think that largely prices in sort of current oil price expectations. So where we have added to introduce some sort of defensive element is we added to Glencore in January. That's a stock that should benefit well in a period of price dislocation between regions, whether it's coal, whether it's oil, whether it's LNG. Their marketing business should do very well there. And then their thermal coal business should do very well too. I mean, we've particularly seen the Newcastle price, which is the Aussie benchmark price, that's increased nicely, and they're a big supplier, a producer and supplier of thermal coal into the Asian region, so they'll be a beneficiary there. And the other one, which we also added, was Exxaro, which is a defensive thermal coal producer in South Africa, obviously with the largest portion of their product going to Eskom. But at the same time, they do have thermal coal export exposure. And it was one stock that I believed had lagged the sort of energy complex in South Africa. If you look at what Thungela had done, and that was another one that we had added to give some sort of hedge against our increased South African exposure on the other side of the portfolio.
Mike, I mean, I must say, I just love how your comments are always grounded in valuations, fundamentals, and always underpinned by disciplined risk management. So thank you so much for joining us. And we look forward to good returns over the next year.
Thank you very much. Thank you for your time. Appreciate it.